Well, good afternoon, everyone, and welcome to Recession Proofing Cash Flow Optimization. I'm very grateful for you taking time out of your busy schedule. I know last few weeks of the year around the holidays can get pretty busy, pretty squirrely. So really appreciate you carving out some time to attend this webinar with us to go through some recession proofing for your business and really optimizing cash flows is the focus today. So as a matter of introduction, my name is Joshua Clifton. I'm the Chief Financial Officer of the Methodical Group. We're a workforce solutions company with one of our divisions, Methodical Finance, that provides solutions in the accounting and finance arena that's sponsoring the event. And we welcome you and thank you again for taking the time. Just a few administrative items before we really jump in. We will have some interactive polling during the course of the webinar. I think it's very valuable for us to learn what our peers are thinking as we kind of walk through the cash flow optimization. And if you're on a mobile device, just make sure you've engaged your chat. There's a chat feature as part of the webinar. Make sure that's open. And then that way it'll engage the polling questions. And then likewise, if you're on a desktop or a laptop, do that as well if you don't mind engaging the chat box or opening that up. And that way you'll see the polling questions as they come through during the presentation. So hopefully that helps for the polling questions. And so for now, we're going to dive right into recession proofing and cash flow optimization. So for those who are part of the first webinar we had, this is actually a series. We went through financial defenses and kind of walked through three core areas where we thought as a pending recession or economic uncertainty, however you want to define it, with that in the purview of 2023, just some things to be thinking about that you can do now and solutions that we can put in place to help ready your business. So the first webinar we had was an overview of the financial defenses, one being optimizing cash flows, which we're going to drill into today, take a deeper dive through that topic, but two and three being reducing costs through automation. And with that, what we did, we really walked through the value add that robotic process automation can bring to an organization, not just in the accounting and finance area, but also in HR, payroll, and some other areas we explored. And then the third item there we highlighted as a financial defense is workforce solutions. And we shared some of what the Methodical Group offers with nearshore, offshoring solutions, but really an extension of that by bending your cost curve down, but increasing the quality of service with our exact skills model that we offer here. So that was our first webinar. Where we're at today, so optimizing cash flows, we're going to look through some solutions to analyze and enhance the visibility into your operating, investing, and financing cash flows. Um, Reducing costs through automation will be a second part of this series. So we've gone through the financial defenses. We'll be going through optimizing cash flows today. And then the next part in this series will be reducing costs through automation and then workforce solutions that I mentioned earlier. Really to build this financial defense structure and readying your business for recession proofing. So we are here today. I'm going to walk through the agenda now. Oh, real quick, if you did not see the first webinar and you are interested in that overview of when we explored these three areas, feel free. We'll have the slides available after this webinar. Feel free to click on the link here and it'll take you to the Methodical Group's website. That'll then activate that video we have in an archive status. So the agenda today with the objective being what are some solutions, what are some ways we can think about how we can improve, enhance, and optimize our cash flows. And I wanted to take an approach by looking at three angles at this. So the one, exploring some best practices for managing cash flows. So if we think of uncertain economic times, however you want to phrase that, whether it be a recession or any type of downtick in the economy or uncertainty, what are some best practices we can do now to get in front of some of that before the recession occurs or before any type of economic uncertainty continues or lingers or gets expedited. The second area is scenario modeling. And what we'll do here is kind of building the foundation for managing cash flows and those best practices, looking at some scenarios that will produce some most likely scenarios, some best case scenarios, and worst case scenarios. And giving the visibility to the key stakeholders by providing that will enable an organization to be able to pivot and flex as uncertain economic times occur. And we'll explore that further, like what that looks like for your organization. In the third area we'll cover today, reviewing key business relationships, and we'll walk through an example of how we can influence, discussions with our key customers as well as our key vendors, and how that has an impact on optimizing our cash flows. So with that, we're going to jump right into managing cash flows. And really, one of the ways to think about this is really identifying the key inputs. So if we're thinking of managing cash flows, we're thinking of the end game in mind, where the objective here is we want to have a cash forecast that provides visibility and value to the key stakeholders. And in order to do that successfully, what we've found here in the Methodical Group is really to make sure we have a strong understanding of our cash inflows and outflows. I've recommended at a disaggregated level, whether that be a division or a geographic area. It's going to depend on your specific business. But looking at it a consolidated look, but also at that divisional level, I think will help give key stakeholders the information they need to make decisions. So in order to do that, what we've found to be successful is really a formula of first starting with FP&A, so the financial planning and analysis part of the organization. They're probably already doing financial forecasting that we can look at. It's probably updated maybe quarterly on some frequency for your organization, but really getting our hands on those financial projections that the FP&A is performing, because that's really going to feed into an input for inflows and outflows for developing a cash forecasting model in your organization. The second bullet I have under there for FP&A projections, not only utilizing whether they're doing a 3-month look, 6-month, 12-month, whatever that looks like. I know some organizations go to 3 years, whatever that looks like for you, but it's also discussing and analyzing and identifying quality of earning items. And really what I mean there is these could be one-off type items that are either coming down the road, or maybe the FP&A team has our 12-month forecast and has highlighted a few additional items that maybe only occur for 2023 and will not reoccur in 2024. Could be some type of legal settlement. Could be a gain that's coming in from any type of transaction that relates to your organization. That's kind of a one-off item that you want to identify. So those are the things, as you're thinking of putting together the cash forecasting model. What we're trying to do is add precision to it, and this is a way to do that. Starting with the FP&A team, working with them, and then identifying these one-off items that could come down in the forecast that maybe haven't occurred in the past or are non-recurring, that you'll want to make sure you incorporate into the cash flow model. The second input we have is identifying those cash inflows from the FP&A, the financial projections that you're utilizing. So one of the things to think about for cash inflows, most organizations have receivable balance. So starting with that in the sense of those are going to be your cash flows that are coming in that current state. So we'll talk a little bit about days sales and outstanding in a moment, but understanding what is our outstanding AR, what do we think is collectible, and when. That's kind of going to be your short-term cash inflows that you're building with your cash forecasting model to determine those cash flows coming in, and including projected revenues with probabilities. So what that bullet is saying is basically, as you're looking at your current AR, this is services that performed or products delivered. Your current AR is going to have cash coming in plus or minus whatever kind of allowance or days sales outstanding of that cash to get in the door. But what this is it's also saying, okay, for some new revenue beyond what we've built or produced in our outstanding AR, as we generate new revenue, what is the probability of those revenues occurring? It could be existing customers that are contractual, and that may be more of a recurring item that you know what kind of revenue is going to be coming in. You know that they're a timely payer, a little more predictable. But for those unpredictable moments of maybe it's new growth or a new SOW, statement of work, that's been signed, whatever that may look like from a revenue perspective, you do want to do a risk analysis on that revenue. What's the likelihood of that revenue that's being billed, converting into cash? And then from a day sales outstanding, when is that cash going to be expected? So again, really taking a detailed look by customer will be helpful there. And then again, from cash inflows, any type of cash receipt type items that were identified in the quality of earnings analysis. Making sure you've got those one-off items covered in your cash forecast. The third item here is cash outflows. So this is helpful to look at historical trends of cash outflows and probabilities as well. So you're going to know your recurring payroll, your vendor payments that are going out. Those are things that are historically recurring. So you definitely want to have that in your cash forecasting model as outflows going out and when they occur. The second item here is really looking at the FP&A analysis and identifying any new items, maybe in that 3, 6, 12 month, however you're projecting it out, but looking through there to make sure, okay, from a historical perspective, we feel like we've covered some of the recurring transactions, but did the FP&A team identify through their process any type of transactions that we may need to be aware of that have not historically occurred? You want to make sure you've incorporated them into your forecasting model. And then looking through any type of contract renewals and other prepaid type cash outflows. So what we found here in the Methodical Group, adding that precision to the cash forecasting model is looking through these items. And what this cash contract renewal and prepaid type is saying is, for my accounting colleagues on the call, so obviously if you sign a contract that's 12 months in duration, you're going to amortize that cost over the useful life of the contract or the contract life. So that in that example, 12 months. So you're going to have 1/12 coming in each month. But the obvious here is the cash is outlaid at the initial part. So you want to make sure your FP&A is going to be on a GAAP basis, which is going to have that expense coming out 1/12 each month. But from a cash perspective, the whole thing's coming out. And so you want to make sure you incorporate those elements wherever there are type of prepaid types or contract renewals. You want to make sure you have the entire cash outlay of when it occurs. That'll help add precision to your model as well. And then again, with the end game in mind, it's really these three mechanical pieces driving and producing a cash forecast that's relevant and valuable to the organization. It's making sure that the three pieces before this are saying we have all the available information that will be valuable to key decision makers. So it's really the baseline of managing cash flows is really identifying our inflows, outflows, creating a cash forecast that will be meaningful to our key stakeholders. The second part of managing cash flows and after looking at our inputs is prioritizing that cash flow outflows. So what this is saying is basically getting into categorization of our costs. And the value here by doing that is you start putting your cash flows into buckets. And this is going to look unique to each organization. So yours may look different than the example I'm sharing here today. But the point is still the same. And that is to identify these costs or these cash outflows in these buckets, because what it's going to do is give you flexibility. And here's why. So the first bucket I have from a categorization is what are some critical operational costs? So these costs are going to recur. We've got payroll, which of course could ebb and flow based on volumes or production lines, whatever's unique to your business, but it's a predictable cost that's going to occur. You're going to have payroll at some level. Compliance, you're going to have taxes, any type of contractual obligations you've entered into. And then of course, if you do have debt on your balance sheet, debt service costs, these are going to happen type of costs that you know are predictable in your cash flow model. So categorizing these as critical, you know those cash outflows are going to happen. Strategic, this could align with the strategic vision of the organization. If there's M&A activity, there's an expansion of a certain division, increasing automation. We mentioned in our first webinar, robotic process automation. That may be an initiative that's being incurred by your organization. And so knowing that those costs are tied to a strategic initiative. So again, maybe not as flexible as some other costs that could be in the organization. If your company's focusing on enhancing customer experience and there's a budgeted cost allocated to that, knowing that that's probably not as flexible as a cash outflow than maybe something else in your organization. So the critical part here is understanding that putting them in the buckets will help navigate through recession proofing, because the third bucket we have of the category is discretionary costs. And what this does is once you have your cash outflows categorized, however it makes sense to your organization, this is just an example we've seen be successful here in the Methodical Group. But once you have kind of that other bucket, the discretionary costs, not deemed critical, not attached to a strategic initiative, these could be opportunities for cost containment or cost improvement. So these discretionary costs could be um, an example here could be laptops or computer equipment that organizations have. Most companies have some type of refresh period. That could be every 3 years when your laptop hits the 3 year mark since you've had it. And it's probably most folks on the phone know that that doesn't always occur. Sometimes it's before the 3 year mark when they crash. But the point is, if you have a 3 year refresh period, what if you moved it to 4? You're still going to have a computer, you still have a laptop, but what if you take it to the 4th year, or if you have a 2 year refresh, what if you took it from 2 to 3? What does that do to your cost model, and how could you save? And from a discretionary, you still need the computer, of course, but maybe that timeline of when you need a refresh is more discretionary on the computer itself. So some ideas you could have to be able to categorize costs in that discretionary, because what that does, it gives you a lever to pull when you're recession proofing your business. If you need to cut your G&A expense from 35% of revenues to 30, how are we going to do that? How are we going to close a 5% gap? Well, the first place you should probably look is in your discretionary cost components. Anything not deemed critical, not deemed strategic, but some other component. And that's where you put your focus on how can we reduce that cost structure or contain it. So identifying, prioritizing, and then from a managing cash flows, we have the cash forecast itself. And so really what we're going to do here is build out what that looks like. So we've talked about identifying cash inflows, outflows to develop the cash forecast, prioritizing those outflows by categorizing them. Again, it gives us a pivot level that we can utilize when we're recession proofing our business to understand these are some costs that are more discretionary in nature. We could flex these if we needed to. If we needed to bend the cost curve by X, we have visibility into doing that. 3 is setting a frequency to review and a duration of time to model. And what that means is it's really building some discipline around your cash forecasting process. So setting a frequency could look like some organizations choose to do a monthly cash forecast that's updated every month and then reviewed with the key stakeholders of that forecast on a monthly basis. Some are more timely in the sense of weekly. I'm sure it depends on what your organization is going through and the cash flow needs, but it could be daily. I've seen some organizations that are in a stretch where you're really looking at that data on a daily basis. So making sure you have a set frequency and a team who's able to produce it. And then a duration of time. I mentioned some organizations take a 3 month look of their cash forecasting model because they just feel anything beyond that may be unpredictable. Most organizations at least run it out maybe through the end of the year or from a rolling 12 month. That's probably what we see mostly is that rolling 12-month process. But whatever it looks like to you and your team, it's really setting that frequency and the duration of time to model the cash forecast. The fourth item to producing a visible and insightful cash forecast that's valuable to key stakeholders is a look back analysis. And I think this one is, to me anyways, is one of the more valuable components because what it does is it provides insight, it provides lessons learned, where you're able to look at, here's where we thought cash would be, and I'm going to pick December 31st. We had a cash forecast saying we would be at $1 million, and when the actual cash occurs, we're at 800,000. So the look back is basically saying, okay, we have a $200,000 variance. Why did it happen? Where did we miss? Or was there information not known at the time? Was it just something that was unplanned and unaccounted for? Which I think most folks on this phone would agree that happens. There are some unknowns that just occur, but a lot of it can be prevented by open communication, whether it's with the FP&A team, key operational stakeholders, and others within the organization to make sure you have a good line of sight on projecting not only the financial projection, but also the cash flow projection. And so the look back then says, really making sure we have a baseline. Where do we want to be? So do we want the actual cash that we're looking at for a period of time to be within 5% of what we forecasted? Whatever that looks like to you and your organization, I think it's important to measure it and then look at the look back period in the sense of identifying, hey, where did we miss and where can we improve and calibrate the cash forecast. Really a critical piece to adding precision to your cash forecasting and something we've helped organizations with here at the Methodical Group. Number 5, that's really utilizing those items from number 4 that I mentioned, the look back analysis. It's incorporating the lessons learned from the look back, as well as any new information that's become available. Things change. Things are constantly moving. I think that's the major known of anyone trying to project, whether it be financials or cash flows. But all 5 of these are going to help you hit the mark. And the accounting and finance, it's not an unknown. That credibility is the biggest component to what we provide to our key stakeholders. And this is a roadmap to ensuring you're able to hit the mark with your cash forecasting. It's something we've helped clients with before. So with that, going through the managing cash flows, we have our first polling question. And just a reminder here, please refer to the bottom right of your screen. You should see a vote button and to open the chat box if you're a mobile user. It is helpful for the desktop and laptop as well. So the first question is, what area of cash flow management is of most important to ensure the cash forecast is valuable, insightful for decision making, and providing visibility? So the 4 items we have here is identifying. So when we talked about the cash inflows and outflows to develop the forecast, prioritizing and categorizing, I think that's part of that flexibility and gives you the insights into knowing, hey, where are our levers to pull if we're trying to hit a target and we're trying to recession proof. If we needed to take our G&A from 35 to 30% of revenues, how are we going to do that? Categorizing your costs can be helpful. Or establishing a robust process to review the cash management forecast on a periodic basis. And then if you do have another idea, not in here that you think is most important, please share. This is definitely something we want to collaborate on and share in the comments. That will be helpful in the chat feature. So we'll give folks a few minutes to walk through the poll. Okay, looks like we have our responses in, and the majority agree that item B, prioritizing cash outflows by category based on a range of most critical to costs that can be deferred, is the most important. And I would tend to agree. I do think each of the other elements, I think building the cash forecast with the inputs, identifying those inflows, outflows, I think that's critical to getting a baseline. And looking at the process to review and how frequently we do it. But I do agree with the poll that really having that categorization is instrumental in being able to build flexibility into your cash forecasting. So thank you for those who were able to respond. Okay. The second item, agenda item, is scenario modeling. And with that, part of the scenario modeling is making sure we've got the right assumptions. So we want to the objective here is to build a flexible cash forecasting model that's going to give us insights. And I try and pare it down really into something simple: a best case scenario, most likely case scenario, and then a worst case. And I think what that does is it provides visibility to the key stakeholders. Obviously, it's going to help with your treasury team and the sense of capital or cash requirements that could come up. Understanding from a worst case scenario, how bad could it get if some of these key assumptions that we flex in our cash forecasting model, where would that put our cash balance and when? Obviously, if you have lines of credit or other type of financial instruments on your balance sheet that help with the funds flow, that's something you're definitely going to want to know, especially as it comes up to year end. How much capacity do you have in your line of credit? How much do you think you'll be utilizing? And then, of course, keeping in mind any type of debt covenants you may have for that debt on your balance sheet. All of those come in mind, which makes it just absolutely critical to have those different scenarios. So we're going to walk through. That's the value proposition of why we need those scenario modeling. We're going to walk through how do we do that? How do we improve the precision in our cash forecasting by cash flow optimization? One of the items for scenario modeling, and again, this concept is focused on identifying our key assumptions, is looking at new business. So if we have, I shared earlier, part of your cash forecasting cash inflows revolves around your current AR balance and when that cash is coming in. But of course, there's revenue behind that that's going to be earned during the year. And it could be from new clients, it could be expansion of new business inside of current clients that we have. Whatever that looks like, it's including probabilities for those new business assumptions. So putting a probability of if we feel comfortable that it's a new statement of work, but it's an existing client, and we feel comfortable that's going to be 100% realized, that may be something we have a higher probability on than a completely new client that maybe they signed the MSA, but we don't have an SOW yet. We still feel comfortable about the relationship, but we're just not sure if it's going to turn into revenue. Those are definitely going to have lower probabilities on your cash forecasting model. Cost of sales is service. So for producing items or we're providing a service to our customers, whatever that looks like for your organization, the point here is to be able to flex that assumption of that percentage as a percent of revenue. So if you know you have some cost reduction efforts going on, or you're relooking at the cost structure of your organization, maybe you have a 55% cost of sales percent of revenue, and you're trying to get your margin to more of a 50%. How are you going to bring down that 5% as part of the equation? But being able to flex and say, if we did improve our cost of sales or service from 55 to 50%, so bumping up our margin 5%, what would that look like from a cash forecasting? So, whether you're using Excel or some of the other technology that's out there, having that flexible feel to pivot that in the sense of moving it from 55 to 50 in that example I shared, and then having it automatically update and say, okay, cash balance would be X if we modified that assumption. I think it's a really important assumption as you're trying to build precision into what the actual results could be. And then day sales outstanding. So how quickly is that cash coming in? We've kind of focused on new business and revenues and probabilities of those revenues coming in, but also understanding if we have a lot of new business with a customer who typically pays them 45 days, you want to make sure you have that baked into your model. And understanding that if we have an assumption currently at 45 days, what if we were able to, and we're going to talk about this in a moment with our key business relationships, but what if we were able to influence that with our key customer and bring that from 45 to 30 days? What would that look like to our cash forecast? So having day sales outstanding as an assumption can help you look at that. And that way you have areas to target with your finance and accounting team of improving. These are just three examples, but improving these three, or if they went the other way, what would that do to your cash balance? Um, the point here is that it provides flexibility to enhance the visibility of your model. So in addition to the key assumptions, a real important part of scenario modeling is the look back analysis. And so we saw this earlier as we were looking through building the cash forecast itself. But the look back analysis for scenario modeling is absolutely critical. And the recycle symbol here is really suggesting as we build the scenarios, we're constantly learning from them to refine and calibrate them. So one way to do that is from a variance analysis. So I mentioned earlier, whatever frequency your organization selects to do the cash forecasting, that's making sure you are looking at that actual to forecasted amount of cash. So what we've found to be successful for our clients is looking at this on at least a monthly basis, where you're looking at the actual cash balance to what was forecasted for that period of time, and identifying what is the variance that we're trying to understand. Without having that variance analysis, we really don't know what problem we're trying to solve. So once we have the first item, the variance analysis, we can identify, if that was a miss. The example I shared earlier, we were projecting $1 million of cash and came in at 800,000. Understanding that 200,000 variance, what happened in there that created that variance, and what we learned from that, we'll want to incorporate back into the model. It could have been, hey, these customers were taking 45, 50 days, and we had it modeled at 30. Well, we're going to need to recalibrate the model or calibrate the model to incorporate a 45 days until we can get them on a 30-day term. Or it could be the inverse. We're paying out net 15 for our vendors. We really should renegotiate and get on more of a net 30 type arrangement. Whatever that is, it's making sure you incorporate the lessons learned from the variance analysis into your forecast. And then the third item here, obviously, you'll want to make sure we rerun the forecast. So this is another one that could be very organizational specific. How often and frequently you incorporate the lessons learned from item one in the variance and the look back analysis and incorporating it, and then how often or frequent you rerun your model. But the point and the key takeaway here is making sure that look back analysis is being performed. It's so easy that it gets left out of the equation and you just roll into the next month and put some of the same assumptions in without calibrating it. So something we've definitely seen be successful here at the Methodical Group. It's something internally we did as well that really drove down our variance percentage from projected cash to actual cash, was performing this exact exercise. So with the scenario modeling, we've got our second polling question. And again, for folks on mobile, if you could open the chat and it'll activate that feature. The question is, when scenario modeling for cash forecasting, which areas do you find have the most sensitivity to actual results? Said differently, when you're doing that variance analysis from actual to projected cash, what's typically popping out? What is the main driver of that variance? So the four options we have here are, is it probabilities of new business? Are we just missing on, hey, we thought this SOW was going to close and it was going to produce that revenue of X, but it came in at Y. So probabilities of new business, cost of services or sales assumptions, is it just costing more to produce or provide a service to our customers? And then is it from predictions of cash inflows from our day sales outstanding? Did we project DSO at 30 days, but it came in at 45? Those are all things that could influence our variance analysis. Or have you seen other items? Have you seen other areas in your organization that have caused variances? So we'll give folks a few moments and then we'll share and walk through the results. Okay, this is interesting. So we've got the results are in, and it looks like it's a 50-50 between A and B, the probabilities of new business and then cost of services, which definitely lines up, I think, with most organizations. Those are very volatile areas, especially if you have an aggressive new business plan where you have new customers or expansion of existing customers. It can get quite volatile in trying to predict the probability of those revenues and when they're coming in. I know a lot of times, if it's in the statement of work stage, sometimes those get pushed out to a different period, and so you may not have a full month of activity that you're expecting. Same with the cost of service, that can get sideways in the sense of if you have some of the costs going in, but the cash related to that cost. If you're in a more of a time and materials where you have the payrolls are going through, but you're invoicing and then they have 30 days to pay. So there's a lag there that could occur that can create a variance from forecast. And of course, in the day sales outstanding, which we'll look at again in a moment, that can have an impact as well. So thank you for those who are able to vote on that. Okay, our last item from a cash flow optimization that we wanted to share today is reviewing the key business relationships. And really what this is thinking through our inflows from our customers, our outflows to our vendors. How can we look through and reevaluate the terms that we have with them? So the example I have here is, again, with our day sales outstanding, knowing that that's a very close barometer of when our cash is coming in. It's understanding our current performance. And what I mean by that is it's trying to get it as much a disaggregated level as you can. The example here is quite simple and something I'm sure most of us are doing. It's looking at our days in AR over a period of time. Now this one's consolidated, but what's underneath this in this model that we've incorporated and used with our clients is what's underneath is at a customer level. We're looking at our day sales outstanding, so you understand who maybe our late payers are, who our all-star payers are, and knowing that if you're going to expand business with one of them, it's being able to influence when that payment's coming in. And sometimes it's just communication, making sure someone on the accounting or finance team is able to ping those slow payers a little bit ahead of time, just making sure you have everything you need. You have any questions on the invoice? So some hand holding there with some of those customers, but it's really going to provide you, once you have the data, understanding where your current performance is, which is the point here. Understanding that at some point in time, this particular client had 52 days of sales outstanding, where their baseline or their goal is 30. So clearly not where they want to be, but you have to know that in order to build a precise cash forecasting model, knowing that that's your days at that point in time. Now, it also gives you an opportunity to influence that, and that's here. So having a goal in mind, if your organization has quicker payers, maybe they're paying every other week, maybe that 15 days is really your goal. And again, the reason here is making sure you have the goal established and you're trying to get to that goal, and understanding my cash coming in is going to be the DSO, and my cash going out is the days sales that are payable, which you don't want to be upside down on. You don't want to have net 15 payments going out to our vendors, but DSO, or day sales outstanding, at 45 days. It's taking us 45 days to collect, but we're paying in 15. We're really upside down in that scenario. So making sure you understand currently where you're at, and then establishing a goal of where you want to get to. And the part that Methodical plays is we can help drive that. So if you have, in this scenario with this customer, in the sense of 52 days, it's putting together a game plan to get us into that 30-day mark. The second item in reviewing key business relationships, I mentioned the customer and vendor terms. So for customers, really it's a matter of focusing on, there are alternative payment methods we could look at. Maybe to help them with their cash flow, we could accept purchase cards, in the sense of it gives them some float on their end of when they pay their purchase card provider, but it's getting us the money more real time. Yeah, there's a service fee associated with it, but is it more meaningful to have that cash sooner if you have some of these late payers who are just constantly, you're having to spend time and money to chase, versus offering a different payment term that really has your team focus on more value-added activities. It could be incentives for paying upfront, or discounts of sorts for early payment. Those are things just to explore, especially with your slow payers. Just coming back to the table and having that business relationship conversation of how can we get to a spot where we're both in a good, favorable position. And then for vendors, same thing. It's really looking at how are we paying our vendors? How is that money going out? We could build our own float and cash by using a purchase card program where it makes sense, and then having that float on our side with the card, the time it takes to pay the card. So I think that's one alternative to explore, as well as any type of service level agreement. So one thing we found to be successful here in the Methodical Group is looking at vendor spend analysis, and most organizations will do that at a disaggregated by vendor, the payments to those vendors over a period of time, to understand who are their big payers that they're paying out to. But I think an extension of that, and the point here, the key takeaway here is looking at the terms by those vendors. So when's the last time we renegotiated a contract with some of these key vendors, having that contract negotiation date or contract expiration date as part of that disaggregated analysis by vendor. It's understanding that maybe it's been 3 years since we relooked at the landscaping costs for if you have properties, or some other type of cost that typically is contractual. When's the last time we put it out for bid? And from a service level agreement, are they providing quality service? It may not just be from the cost side and bringing that down, but it could be increasing the quality of service we're getting from those key vendors. So relooking and making sure there's a team that's monitoring not only the cost component, but the quality of service that's being performed. So with that, to wrap up reviewing key business relationships, we'd like to know what area of cash flow optimization do you find most challenging? And then as we kind of walked and progressed through the conversation, what would you be more open to discussing further? So we mentioned the managing cash flow assumptions and building that valuable and insightful cash forecast. Scenario modeling, I mentioned the best case, worst case, most likely case scenarios and how you build those and obviously the flexibility in the model that you use to be able to pivot certain key assumptions to generate what that would look like, provides visibility. Or it could be reviewing key customer and vendor relationships. This is something else we've done in the past with our clients where we help them through those terms and maybe relook at the disaggregated analytics by customer or by vendor to help you identify which ones we look at first. Or you could just be a cash flow optimization wizard, and we would welcome your comments and ideas as well. Um, so if you can, take a look at the vote. And again, for mobile users, if you can open the chat and then vote, that would be greatly appreciated. Okay, and the results are in, and it looks like scenario modeling, which I do find that to be probably the biggest value add of the services we provide. Providing our clients and our customers with the insights into not just having a cash forecast. That's great to have the item A. I think it is the baseline, kind of table stakes. But being able to have those scenarios and model out the different cases, best case, most likely, and worst, that's how you provide some navigation through recession proofing your business. You're able to pivot on some of those items if a worst case scenario does occur to get in front of them. And then also from your balance sheet perspective, you're able to look at your line of credit. How much would we need? How much capacity do we have to give you some runway to talk to those key banking relationships if that's something you're going to need to weather through a recession storm? So I totally agree with the poll result there, the scenario modeling. I do think something that tends to get left out and kind of pushed to the bottom are renegotiating or relooking at key customer and vendor relationships. So it is something I would encourage the audience. If you haven't done lately, make sure you pull that a disaggregated look at when's the last time we looked at some of those key vendors that were paying out and renegotiated some of their contracts. So happy to help with any of these. If you do have questions, we do have our contact information here. And again, we'll make sure we send the slides that have a link to our website where you could look at these webinars. Um, but if you have any questions, thoughts, or ideas you wanted to share from the presentation, feel free to connect. And again, I can't thank you enough for taking some time out of your busy schedule the last few weeks of the year as you kind of ramp up for the new year. And I wish everyone a happy new year in 2023 and the most success. So thank you again for joining.